Chapter 3, we look at what we call adjusting entries. And adjusting entries are simply entries that we make at the end of a period whenever we're trying to get our financial statements up to date. The reason that we need adjusting entries is because with GAAP accounting, we are doing accrual-based accounting. And we'll get into what we mean with accrual-based accounting in the next couple of slides, and that's as opposed to cash basis accounting. And with accrual basis accounting, we need to recognize as expenses in the time that they are incurred. And we'll look at specific examples, but sometimes we need to accrue something because we have incurred a specific expense before the actual cash has been paid. Meaning basically we have gotten some type of benefit. We haven't been billed for it yet, but we will be billed. But the fact that we have already gotten the benefit as of the current period, we need to recognize that, and we do it through the accrual process. This is very important because anytime we are finishing or completing an accounting period, we need to get our books fully up to date. An accounting period, typically, most people think about the year. You have a one-year accounting period. We can also look at semi-annual accounting periods, quarterly periods, or monthly periods. It all depends on when the information is needed. And the bottom line is if we are putting together our annual financial statements, or our semi-annual, or our monthly financial statements, no matter what ending it is, we need to make sure that our books are fully up to date as of the day of the cutoff. And this is important because sometimes the billing process, meaning when we get a bill into our company, is slow. So let's think about we have some type of utilities that we use during the current year. Let's just say that this was during 2015. When we close our books at the very end of 2015, so on December 31st, we want to make sure that our books recognize that that expense was for 2015. However, we won't actually get the bill for those utilities until sometime within the first month of 2016, because typically you get a bill in the mail a couple weeks later, maybe mid-January. However, we want to make sure that our financial statements, when we close the books on December 31st, we want to make sure that we show that that expense or those utilities were for 2015, even though we won't get the bill for 2016. And the way we do this is through these adjusting entries. And there's lots of different types of adjusting entries, and we'll get into those as we move along. But that's the basic idea. We want to accrue for something, and if you accrue for something, we're basically just recording that transaction in the current period. I'm going to quickly explain the difference between accrual basis and cash basis accounting. Keep in mind, cash basis accounting is not GAAP accounting. So if you are following GAAP accounting, if you're any type of a public company, you cannot use cash basis accounting. The same thing is true if you're a company that borrows a lot of money from banks. Oftentimes, banks are going to require you to use accrual basis or GAAP accounting. And that's simply because they want to know when they are lending you money that you're using GAAP accounting, and therefore they understand the way you're making your accounting entries. So quickly, what's the difference between cash basis and accrual basis? The bottom line with accrual basis is that we are recognizing our revenues when they are earned, and we are recognizing the expenses when they are incurred. When we look at some examples, this is going to seem more concrete because that seems like a fairly intangible type definition. But once I explain cash basis, it'll help you better understand what we mean by earned and incurred. So cash basis accounting, the only time we make transactions and make records of those transactions are when cash is either received or when it's paid. So if you'll think back as to what you've already been learning, sometimes we make a sale and someone is not going to pay us until the next week. When that happens, we go ahead and we record the revenue. Even though we didn't get the cash, we earned the revenue, so we go ahead and record that transaction. Rather than debiting cash, we simply debit our account receivable to show that we have some type of promise to get money in the future. If we were following cash basis accounting rather than GAAP accounting, we would never record an account receivable. Instead, let's say that we made a sale on, January 1st. We made a sale, but that person is not going to pay us until January 15th. Under accrual-based accounting, we would need to record an account receivable and the revenue on the 1st when that sale was made. On cash basis accounting, on the other hand, we would not record anything on January 1st when the sale was made. Because cash basis accounting, we only record transactions when we get the cash or when we pay the cash. So under cash basis accounting, we would wait until January 15th when that person pays us the money that they owe. And what we would do is we would go ahead on January 15th as debit cash and credit our revenue. But again, cash basis accounting is really only used by very small companies who are not otherwise required to use accrual basis accounting. So we have another example here. On December 1st, 2015, we have a company who paid $2,400 in cash for a 24-month business insurance policy. So let's go ahead and think about this. $2,400 covers 24 months. So that's basically going to be that we have an expense of $100 a month because this is business insurance. Using the cash basis, the entire $2,400 would be recognized as insurance expense in 2015. Then no insurance expense from this policy would be recognized in 2016 or 2017. So let's look at this. If we're using cash basis accounting, cash basis tells us that we make entries when cash changes hands. So if we paid for that insurance policy on December 1st, 2015, you can see here this calendar represents 2015, we would recognize the entire amount as insurance expense in December of 2015. But in truth, does that make sense? Because they're telling us this policy, we're paying it at the end of 2015, and we're going to use it during 2016 and 2017. So this is where we're going to get the benefit. So it really doesn't make sense to recognize everything in 2015, and that's why we use accrual-based accounting. With accrual-based accounting, we would go ahead and recognize in December 1st, 2015, rather than recognizing the full amount as an expense, we would recognize that we have a prepaid asset, and that's prepaid insurance. And then, as every month passes, as we move through 2016 and 2017, every month we would recognize that $100 of that prepaid asset is going away, so we're going to reduce the asset with a credit, and then we would recognize $100 of the expense as we move through the insurance coverage period. Now when it comes to recognizing revenues, we follow what we call the revenue recognition principle, and this states that, again, we're using accrual-based accounting, and it simply tells us that we recognize revenue when we have earned it, meaning that we have either given the product to our customer, or if it's something that we're sending through the mail, that we have actually delivered that item. And we do not recognize revenue until we have fulfilled all of our obligations. On the other hand, when we recognize our expenses, we use what we call the expense recognition principle, or more commonly, the matching principle. And with the matching principle, the goal here is that we will record expenses in the same accounting period as the revenues that those expenses helped us to earn. So let's go back a couple slides and just make sure that we kind of make sure that all of this makes sense. So when we're talking about when we are going to recognize expenses, we want to recognize our expenses in the same period of the revenues that they helped us earn. So how does insurance help us earn revenue? Okay, it's not a direct link because we're talking about insurance. However, in order to be able to have a business, you need to have insurance. So if this insurance is allowing us to do business for 24 months, it is therefore helping us to earn revenue for those 24 months. So we want to go ahead and recognize that expense in every month in which we're able to do business because of this policy. So that's what we mean when we say that we want to match our expenses with the revenues that they help us earn. Because the bottom line is that a lot of type of expenses, although they're not necessarily, for example, the cost of the goods that we sold, they still do help us earn revenue, and that's because in order to carry out your business, there are various things that you need. For example, you have to pay taxes in order to have a business. You have to have certain business licenses. You have to have insurance and pay utilities. And without any of those specific things, you cannot run a business, and therefore you cannot earn revenue. So moving forward, we're going to actually look at what are our specific adjusting entries. So when we learn our adjusting entries, we're going to learn them in 4 basic categories. You can see those shown over here. And then these basic categories can then be looked at into 2 basic categories. Right now we're going to look at what these 2 categories are, and then over the next slides we'll go through our specific entries. But so for our different types of adjusting entries, first we have entries where we have either paid cash or received cash before we have actually had an expense or earned the revenue. And we'll look at those as we move forward. The other hand is where we have already had an expense or we have already earned revenue, but we have yet to pay or receive cash. So keeping in mind, these items up here, if we have a prepaid expense or unearned revenue, this is where the cash has already changed hands. On the other hand, accrued expenses and accrued revenues, this is where we have either have revenue or an expense, but the cash has not changed hands yet. And we'll explain what that is as we move through the next couple of slides. So our first example is a prepaid or a deferred expense. This is actually something we already looked at when we were looking at the very first example of accruals when we were talking about prepaid insurance. And this is a prepaid expense, so let's go back here. So this is a case where we have paid cash before the expense needs to be recognized. So let's look at that. If you'll remember, with prepaid insurance, our example was we paid cash ahead of time for a policy that was going to last us the next 24 months. So we have paid something, but in truth, we haven't used up that insurance. Therefore, we have not expensed it already. So the way we account for this is by having a transaction for a prepaid expense. A prepaid expense, you can think of this as almost like a gift certificate because we paid it in advance, and then we're going to be able to use the benefit of that over the next 24 months. And we have a certificate for the value that we have already prepaid. Because this has value, this is an asset. So this will be a prepaid expense asset. We will go ahead and debit the asset for the full amount that we prepay. So in our previous example, we prepaid $2,400. So in the very beginning, we would show that our asset increases by $2,400, and then as time goes by, so as we actually use up that benefit, we will expense it as we move forward. So again, in that example, we had paid 24 months in advance, and the total was $2,400. So therefore, we would expense $100 a month. We would show that by showing a debit to our expense, and then we would credit our asset for the amount that it is being reduced. So after the first month, we would credit $100, and that would show us that what is left would be our beginning balance, which was $2,400, minus $100. That means our remaining prepaid asset was $2,300. So here we just have our actual T account for prepaid insurance. Here's where we put our beginning balance because this is the full amount we prepaid. And then as time goes by, we will expense the portion that we use up. So we'll recognize that as we receive the benefit. Here you can see we recognize that expense and we reduce it by the portion that has now been used up. You can see now here we have our ending balances. This is after 1 month of our insurance has been used up. Here we have the portion that goes on our income statement for our expense. Here's our actual journal entry. It's basically the same thing that we were doing before. We were looking at it on our T accounts, but this is the actual adjusting entry. So we recognize our expense here. This is just the debit side of that T account. Insurance expense of $100, and we reduce our asset, our prepaid insurance asset, by $100. So this is our first example of an adjusting entry. Another example where we make adjusting entries would be for depreciation. We'll have a whole chapter related to depreciation, but at this point we're just going to look at straight line depreciation. What we mean by depreciation is we are recognizing the fact that if we have a car or a piece of machinery or even a piece of furniture, as time passes, the value of that item is used up, and we recognize that through the depreciation process. We calculate depreciation by taking the cost of our asset and dividing it by the useful life. So to make things really simple, let's say we have an asset that costs $100 and it's supposed to be useful for 10 years. $100 divided by 10 years tells us that approximately $10 of value is used up or expensed each year. You can see here we can also include a salvage value. So that means if we can sell that piece of equipment or furniture for some type of salvage value at the end of its life, we'll take that portion out of the asset cost. So let's say again our asset cost $100, and let's say it has a $50 salvage value. We would only be depreciating the difference between $100 and $50, which is $50, over our useful life. If we still have that useful life of 10 years, that would mean that we are going to depreciate $5 per year, because then at the end of those 10 years, we still have an asset value of $50, and we can bring that, say, to the junkyard or to some type of resale and sell it and get that $50 back. So our adjusting entry for depreciation simply recognizes this expense. You can see here we just have some definitions over useful life and salvage value. Now let's work through an example. We have a company who purchases some type of equipment on December 1st for $26,000. We have an estimated useful life of 60 months, and we have a salvage value of $8,000. So first let's go ahead and calculate our straight line depreciation. They expect the equipment to be worth $8,000 when the 5 years is up. So only $18,000 of the cost needs to be spread over the next 60 months. So that is the portion that we are going to be depreciating. That's $26,000 minus $8,000 gives us that net cost, and this net cost is what's going to be in our numerator. Divide that by our useful life, and we can see that we need to depreciate $300 per month. We do this by recognizing a depreciation expense every month as we get the benefit from that equipment. So you can see here, this is our beginning T account for our equipment. We bought the equipment for $26,000, and then we recognize depreciation through depreciation expense. This is simply another category of our expenses. It'll be on your income statement. And then we have a new account. This is accumulated depreciation. Accumulated depreciation is what we call a contra account. You can have contra asset accounts, contra equity type accounts, but in this case this is a contra asset account, and what it means is that this goes along on our balance sheet with our asset accounts. but it is contra or contrary. It works the opposite way of regular assets. So anytime we increase accumulated depreciation, we increase it on the opposite side that assets normally increase. If you'll remember by rule, assets increase on the debit side and decrease on the credit side. So your contra asset account is going to be opposite. So we increase accumulated depreciation by $300. The reason we do this is because when we put these onto our balance sheet, we'll put equipment and accumulated depreciation together, one under the other, and we'll net these two together. So if you were to net accumulated depreciation with equipment, the net value would be a reduction in your equipment asset. So the net book value, instead of equipment being $2,600, your net equipment value is $2,500 or $25,300 because it's $26,000 minus $300. So now we can see the actual adjusting journal entry related to depreciation. You'll see here we recognize the portion that we are going to expense. In this case, we are going to expense the depreciation for the 1 month of December. If you go back to our previous calculations, you'll remember we're depreciating $300 per month. So we have depreciation expense of $300, and then we want to increase this accumulated depreciation, which is a contra asset account. So it works the opposite way of regular assets, and that's why we are increasing accumulated depreciation here with a credit. So this is our journal entry for depreciation expense. Here we're just going to show quickly the partial balance sheet, and what we're concentrating on is how do we actually show depreciation on the balance sheet. We're going to show here under our assets, we'll have the equipment category, and then right below that we show the related accumulated depreciation. So less the accumulated depreciation for this equipment, and here you can see our net book value. Now here you can see $900. If you go to our previous example, keep in mind we were depreciating $300 each month. So at December 31st, we recognized $300, and then if you look at this balance sheet, we're looking at the end of February. So December we had $300 of depreciation. We added to that another $300 in January, and then by the end of February there was another $300, and that's where this $900 is coming from. It's $300 of depreciation per month for 3 months. So 3 multiplied by 900 is where that's coming from. So at the end of February we have a net book value of $25,100 in our equipment. So that's the equipment net of accumulated depreciation. We're going to now move to the next category of adjusting entries, and this is our unearned or our deferred revenue. And this is simply where we have received cash for something that we have not earned it yet. And this is pretty common if you think about if you buy something online. You have to go ahead and pay for it when you check out. Now, the moment that you pay for those items, nothing has been sent to you yet. You don't have the goods that you've purchased. So at that point, until the company actually ships the goods to you, their revenue is unearned because they have your cash, but they have yet to provide their service or send you the goods. Another classic example is if you think about a magazine subscription. You pay for that entire subscription up front. However, they have not earned that revenue until they send you all the magazines that they owe. So they will earn that revenue month by month by sending you what they owe. So they fulfill their duty, and therefore they earn their revenue. Unearned revenue, it simply is when a company has gotten cash before it's earned. So if they do not fulfill their obligation, they would have to give that cash back. And until they do that, they owe something to you. So a company has a liability equal to whatever it is that they have cash for it, but they have yet earned. because legally you could go and say, okay, I paid for this subscription and they never sent me my magazines. I want my money back. So someone can be held liable for the amount of your cash that they have, but they have not earned. So anytime we recognize unearned revenue, if you'll remember, liabilities by rule increase with a credit. So we'll put the full amount of any unearned revenue on the credit side of our liability. And then, as we earn that revenue, we will need to make adjusting entries to show the amount of our liability that gets reduced as we earn it. And so, as we reduce our liability, we can now show a credit for revenue because we have actually earned that revenue. Let's actually look at an example of how we show this type of adjusting entry. So here in this example, we have a company that charges $100 per month to spray for pest control. So a customer prepays $600 on November 1st, and this gives them 6 treatments. So how do we actually record this? In the beginning, we recorded this as unearned service revenue for the full amount because we have someone's cash, we have $600, and we now owe them some type of service. So we got their cash, and we now recognize a liability. So then, as time moves on, we need to adjust for the portion that we actually now have earned. So at the end of the year, the company has applied 2 treatments for the customer. So what that tells us is that we have now earned 2 of those 6 treatments. So at the end of December, we need to make sure that we update our books for that. So you can see here we will make an adjustment for $200. That's $100 for each treatment, so 100 multiplied by 2 shows that we needed a $200 adjustment in order for our ending balance to properly reflect what is actually still unearned. And we do that through the following journal entry. We will debit unearned services revenue, and that is because we are reducing our liability because we are no longer liable for this. That means we have actually done this. And then we can recognize that this revenue is no longer unearned. It is now service revenue. So this is how we make our adjusting entries for unearned revenue. So our next type of adjusting entry is for an accrued expense. And this is a cost that has been incurred, meaning that we have had some type of benefit of something in a period, and this cost has yet to be paid, and it is not yet recorded. So in these cases, we'll need to make an adjusting entry that recognizes the expense, and then because this has not been paid, we also need to recognize that we owe someone money. So we need to credit the liability to increase that liability. Now let's actually look at a specific example. We have an example where at the end of the year, we have salaries expense of $5,000, but this has not been yet paid to our employees. So how does this happen? Let's say that at December 31st, we need to close our books, but normally we pay someone on Friday. But let's assume that December 31st is a Thursday. So we need to make sure that on Thursday, December 31st, we show that we owe someone money. We have not yet paid them because we're going to pay them on payday Friday. But we need to make sure that our books show that we have an expense and we owe someone. So we do that here by accruing our expense. What you'll do is you'll need to show that we have a salaries payable for the full amount that we owe, and we need to accrue that expense, meaning we need to record that expense. We have already had the benefit of this work, so we simply need to show that we have salaries expense and salaries payable for $5,000. Now, on the next day or whenever payday happens, we'll simply show that we need to get rid of this liability, and you do that with a debit. And then we don't need to record salaries expense again because we've already recognized that expense. Instead, we debit salaries payable because we need to get rid of the liability. and we'll show at that point we credit cash because that is when we're actually paying the cash. So this entry here is the accrual for our salaries expense. And then once we actually pay that payable, that's when we'll show the cash paid and the payable going down. Let's look at another example for these type of accrued expenses. So we have a company and they have a mortgage, and for this mortgage they have incurred $1,000 in annual interest. And this is fairly typical because there are some contracts where you only pay interest once a year. And in this case, the company intends to pay their interest on January 3rd. However, on December 31st, they need to close their books and they need to get them up to date. So because they have had the benefit of having this mortgage throughout the year, they need to go ahead and recognize the expense because they have used up that time that this interest represented. So we need to go ahead and accrue for that expense. So we'll need to show first that we have a payable because time has passed and we have had the benefit of this mortgage. We do owe someone money. It doesn't matter that we haven't paid them. What matters is that we are legally obligated to pay them. So we show that we have interest payable for the amount of our liability, and we need to recognize the expense. So here we have interest expense and interest payable for $1,000. Then on January 3rd, we'll show that we made our payment. So at that point, we'll get rid of the payable and show the credit to cash. But here, this example, right here, this entry that you see, is our adjusting entry for accrued interest expense. So our fourth and final type of adjusting entry is for an accrued revenue. An accrued revenue is simply the opposite of an accrued expense. It's revenue that has been earned, but it has yet to be recorded, and the cash for that revenue has yet to be received. So in this case, we'll need to show an increase in our asset, and that asset is going to be the fact that we are owed money, so some type of receivable. And then we'll need to show the fact that even though we haven't billed that customer or we haven't gotten the money from them, we have in fact earned this revenue, so we'll need to credit revenue. Let's look at a specific example. Here we have a company. They have completed services for $1,000 for a client. So if they have completed a service, the key thing there is that they have earned this $1,000. It doesn't matter that they don't have it yet. They have earned it, so they have revenue that they need to record. And this client has yet to be billed for those services. And this is pretty typical in a company. I think as an individual, if someone owes me money, I'm immediately going to bill them. But the truth is in a lot of companies, maybe they don't send their bills out until the end of every week or the end of every 2 weeks, whatever their billing cycle is. So this is common. Oftentimes there is a little bit of a lag between when a service is completed and when someone is billed. However, if we close our books before the person has been billed, we still need to show that we are owed that money. So in this case, we'll need to show that we have an account receivable now for $1,000. Then we also need to show that we have already earned this money. So we'll show that by making an adjusting entry to show we increase our accounts receivable and we increase our service revenue. Let's look at one other example. In this case, a company has earned $500 of interest from some type of government bond. Now, if you'll remember, with our accrued expenses, we also had an interest example. And this is the same thing. Oftentimes, interest is only paid maybe on an annual basis. So if we are closing our books on December 31st and we have earned revenue because we have loaned out our money, we need to show the fact that we have earned that revenue and we are owed that money by someone else. So we'll do that by showing that we have interest receivable because someone owes us interest, and we have already earned this revenue because time has passed. We were loaning someone our money, and we have therefore earned this interest.